Hello, I'm Gary Korolev. I'm sure you know why we are here today. Given what's happening in the markets, combined with the style of our new president, that has at least half the country spooked at this point. For instance, I have been getting, as a wealth manager, a lot more investment related and market related questions than I usually get, because if you look at across the country, and I guess the demographics of our practice of our investors are pretty similar. At least half the country is quite upset with what's happening because they may not have voted for the current president. So that, combined with his quite dramatic style, and the fact that the market's going down at this time with all the changes that are happening around the country so quickly, is causing a lot of uncertainty, especially for folks who may have been on the other side of the aisle and still be on the other side of the aisle. So today we're going to attempt to be as objective as possible and just stick to the numbers and stick to the charts, so to speak, so that you can get a sense of what we think about the markets based on the research that we follow and how we're investing going forward, so that we can put emotions aside if we can and just continue to have that long-term focus. What you see here, the first chart, so thanks to one of our research providers, Real Vision, MIT, you can see that one great way to look at investing is break up the macroeconomic environment, or the big picture economic environment, into 4 different seasons. Just like there are in the real world, you have winter, summer, fall, spring. Winter is the only season where you don't want to be invested in risk assets like stocks. You want to be in cash and conservative bonds. But there are other seasons you can feel pretty safe investing. And so if you look at here, this chart, as this is as recent as February of this year, you can see that most countries are actually in summer. You got India in winter or in a recession. The rest are actually doing quite well, including the US at the top here, still in summer officially. So we're still full go overall over the cycle. We're still in that part of the cycle where we would stay invested in risk assets, on this measure at least. So one interesting factor that I've shown to some of our investors, but I feel like this may be useful to show again, is how the dollar is acting versus other currencies. Because when it comes to liquidity, or other countries, investors across the world having money to invest and add to the markets and pay down debt, greatly depends on the value of the dollar versus those other currencies. If you look at the charts here, you can see the white line, which is the value of the dollar during the Trump first term, 2016 here and 2017. And as you can see, you had a rise in value of the dollar into 2017, and then you had a steep decline, which really helped the markets do very well during that period of the first full year of Trump's term. And what are you seeing here with the green line? The green line is almost perfectly tracking Trump's first term, with the dollar increasing sharply at the beginning of his term and now falling sharply, and likely going to continue to fall, which loosens up the markets, provides investors with more money and more liquidity, and likely to help the markets stay elevated. Another chart which compares Trump's first term versus what happened today, or what is happening today. The white line is the global money supply, or M2. Why is this important? Because at this point, there's so much debt in the financial system, especially during or after the global financial crisis, that the system on its own is not sustainable. So it depends on injections, periodic injections of massive liquidity or new money into the system by central banks. And so liquidity and how much money is in the system is often measured by the global M2. So if you see here, the white line, again, is after the Trump election, liquidity or the money supply went down, and then pretty sharply and steadily increased all throughout 2017, which of course added to the stock markets going up. If you look at the green line, uncanny and unbelievable how close it's tracking Trump's first term. You had a reduction in liquidity. Now you've had this little jump, and then another reduction, and now it's tracking the global M2 is closely tracking the upward trajectory of what happened during the 2016 through 2018 timeframe, which again is positive for the markets. Here we have a very, at least historically, very effective indicator of market performance. The green line is the GMI Financial Conditions Index, 3 months lead. So if you see here, it's simply moved 3 months forward, the green line, because it leads what we're seeing here, the change in Bitcoin, what's being used here as a proxy for risk assets. Bitcoin, because many investors are interested in Bitcoin at this time, it's used as a proxy. It's just a more volatile. It goes up more when the stock market goes up. It goes down more when the stock market goes down. It's a more volatile risk asset. So we could have used NASDAQ or the S&P in this chart just as well. But Bitcoin here just shows you how closely risk assets track this financial conditions index. And in the past, this financial conditions index has predicted what would happen in the future in the markets. And of course, none of this is, the disclaimer is this is not financial advice, because again, if you're watching this video and you're not a client of ours, I'm not making recommendations to you because I don't know your situation. But what you're seeing here really is we see correlation, and at least this forward-looking indicator, which usually has a 3-month lead to the change in Bitcoin price, is showing that we are likely to see a upward move in Bitcoin or in other risk assets, more importantly, because most investors don't have that much in Bitcoin over the next few months. Now, you may have heard that what retail investors do is often the opposite of what the market is going to do. So here we have the NASDAQ 100. The white line is the NASDAQ 100. And the green area at the bottom, that is the sentiment survey of how many retail investors, so folks who invest on their own and they're not professionals in terms of investments, how many of them, what percentage of those investors is bearish or negative on the stock market. And what you see here, these bars here, when over 60% of these retail investors are bearish, that's when you see these purple lines on the screen. Now, what do you notice here? We've had very few times that over 60% of investors were bearish. We had around 1990, around 2008, around 2022, and now in 2025. Now, every single time that we've had more than 60% of investors bearish, what do you see happen here in the stock market? You see a bottom forming, right? So this is what this is showing is when most investors that are retail investors are bearish on the market, it's actually a indicator which you should probably do the opposite of what these investors are doing. It's a contrarian indicator because it's telling you that very shortly, we're likely to see a nice gain in the market. So you see here, so this is where we are. We've had a little bit of a drop in the market, but investors are extremely bearish, again, probably because all these changes are taking place and we've had a new president, which is quite divisive, depending on which side you are on. Here is another chart of the NASDAQ, and again, the global M2, the global money supply. So what do you see here? The white line is the global money supply, and the NASDAQ is an index of the stock market in the US. And of course, you can see that both lines are very closely correlated. But what you see here is there's a reduction. This is in the mid-2024. There was a reduction in the money supply, the global M2 with a 10-week lead. And then what you see here is a subsequent reduction in the value of the stock market, which is the NASDAQ 100. So you see this big drop, which coincided with this drop in liquidity. Another time here, already in 2025, we've had a drop in liquidity over the last couple of months. And what you see here is the stock market, NASDAQ simply catching up to the downside. But what do you see here? What is this leading indicator showing you? Because the stock market lags by about 10 weeks, this indicator. But this is showing you, at least if the past has any guide, that we're likely to see a recovery as the stock market gains its footing based on the actual liquidity numbers and not just the emotions in the market. Here's another indicator, which is interesting. The NASDAQ 100, which is the white line, and the percent of stocks trading with a 14-day RSI of less than 30. So these stocks, when the percentage of stocks trading with a RSI of less than 30 or very bearish trading, that's this line here. So any time when a stock reaches over 20% of stocks that are trading with a 14-day RSI of less than 30, what do you get? So here you had a short-term drop. Here, gains were soon to follow with some volatility later. Here you've got short-term drop with a recovery afterwards. Here you've short-term low. Here you've got I guess, a break even. This is not a perfect indicator, but now you see here we've had a short-term bottom most likely, and the sentiment is, you could say, very bearish, and that's often a time when you could see a nice recovery in the market. Again, another chart of global M2, the global money supply, again, because it's so important to how the market behaves. This is a 12-month lead, this is a 12-week lead over the price of Bitcoin. Again, we're using Bitcoin because it's a proxy for all risk assets, for stocks, and mostly it's for stocks because they're the other major risk asset. But Bitcoin is simply the more volatile of the two. It goes up more when stocks go up, and it goes down more when stocks go down. So what do you see here? Look at the precise tight correlation of Bitcoin to M2, global money supply. And what are you seeing here? This is the bottoming zone that we're going through right now. We've probably got a little more time here that we need to go through, catches up, and that extra liquidity helps buoy prices of assets in the markets. Now, we need to get into another factor which is affecting monetary policy in the United States, inflation. So if we want the Federal Reserve to ease, they have to forego their worries about inflation, because the Fed is worried about inflation, so therefore they are not crazy about being overly easy, and they're not crazy about lowering interest rates, even though they really want to lower interest rates because they need to refinance about 10 trillion worth of US government debt this year. And they don't want to do it at these high rates, especially if they're focusing on saving every single dollar they can to lower the deficit. So the easiest way to lower the deficit is simply to have a lower interest rate on your debt. But to bring down the interest rates on the debt to lower rates, the Fed needs low inflation. So that's why this factor is crucial. And as you can see here, Trueflation US inflation index has dropped sharply recently to below 3%. And the US CPI year over year, as you can see here, is also tracking closely. So that's a positive factor in terms of having easy monetary policy, where the Fed can feel pretty safe in lowering rates and increasing the money supply and levitating asset prices down the road. Again, I'm going over liquidity a lot because it seems to be the most important factor in levitating asset prices. So this is another way to look at liquidity. A GMI Global Central Bank Net Liquidity Index. Now, this is a little bit of technical analysis. If you look back, we had a big run up in net liquidity, which of course brings up stock prices and crypto prices. And then we have what this is called a consolidation, okay? Or a pennant or a flag or a volatility contraction pattern. So what you have is a nice gain, and then you have the market kind of rests, consolidates, and then you have another big swing upward and another consolidation, okay? Now this is central bank net liquidity. So you see what happened here, right? And big increase in liquidity after this consolidation. What do you see here? An even bigger consolidation. What do we think is going to happen afterwards? I mean, at least if this analysis is proven correct, then we should see a massive increase in liquidity as well, as central banks need to stimulate due to a weak economy. This is another chart from Cross-Border Capital. What you see here is liquidity has been increasing since the end of last year, as we showed you on those other charts, which means, again, asset prices should follow. We're not quite at all-time highs yet like we were back back a few months ago, mid last year, but we're getting close to that level of liquidity.